Hello everybody, this is Troy, Senior Account Manager with AUDJPY. I'll be leading the presentation this evening on technical analysis. Before we get going, I just want to do a quick systems check. Give me an OK in the chat box if you're hearing me clearly and seeing the screen all right. Okay, great. Looks like we're good to go. Thank you very much. Okay, so a lot going on the charts, a lot of movement on the indices, on gold, oil, some of the currencies as well. We'll take a look at as much of it as possible. And, you know, as we get going, obviously keep in mind, as always, no one investment is guaranteed to profit. All investments have risk. Including trading on Forex, CFDs, spread betting, options. Also risk is involved. Obviously, there's also the possibility for nice profits, which is why we're all here, to hopefully perfect our strategies a bit more from an educational perspective. Keep in mind that what we cover is not meant to be financial advisement, but the information can be very, very useful in adding to or even developing new strategies based on different tools and information that can be helpful for you. Now, our full risk disclosure statement is found on AUDJPY.com. You're welcome to check that out. One thing to keep in mind, and I've been mentioning in the recent webinars for anyone who's new to the webinars, if you're using our AvaGo app, there's actually a very useful tool only found on the AvaGo app. If you log into your trading account there, it's something exclusive really only to AvaTrade as well. There's protection offered called Ava Protect through the AvaGo app on all the FX pairings, gold and silver also. You'll see that for defined time periods like 1 day, 2 days, some of them even have shorter time periods like an hour or 2 hours that are starting to be added. For a flat cost, you can have protection against loss for defined time periods, and your profit is, you know, unlimited basically, as far as it might go the right way for a flat cost on the risk. So that's something to check out. If you have any questions about it, talk to your account managers. But it can be, the AvaGo app can be downloaded from our website. Just go there with your mobile device or check your app store, just keyword search AvaGo, and you'll find that app. It's really useful. There are other nice features on it as well that you don't find on the MT4 mobile app. So it's something to check out. Now, keep in mind as we go over the technical analysis this evening, there are a couple main types or ways of doing technical analysis. We tend to lean on the manual methods of technical analysis. Now, in general, what is technical analysis? It's looking at the historical data on the charts, looking for repetitive patterns, looking to see if you think something's overbought or oversold, different formations you might be looking for, or support and resistance levels, price levels. And we'll go over those types of concepts, the basics and even advanced stuff as we go along on the live charts. And so we tend to lean a lot on those manual methods of technical analysis. But another direction is to use indicators along with it or separate from your manual technical analysis. I tend not to lean on those so much because you know, they can't take into account the fundamental news that we also take a peek at with our technical analysis to understand which way the wind is blowing. Indicators can't really take that into account if you're looking at, I don't know, an RSI or stochastic indicator, Bollinger Bands. They tend, if the markets are run in one direction because of certain fundamental news, they tend to give false signals on one side of the indicator and good signals on the other. And so you have to understand the limitations of the indicators along with your manual methods and the fundamental news. And then indicators are just great. Okay, they can be part of a strategy for sure. And there are a lot of indicators available on the MT4 as well. As we go along, if you have any questions, please feel free to ask. You don't have to wait until the end of the webinar, as this slide would suggest. You can give input, comments, suggest assets to look at, whatever you think is helpful for the audience as a whole. You're welcome to contribute some ideas and ask questions. Okay, so quick, before we jump on my demo account, what I want to do is take a look at some fundamental news, which I know that's not the topic of the webinar, but it kind of goes hand in hand. We keep hearing about this, so it's in the headlines. I just went to some main news sites, and here we go. This was one of the first headlines you find. Wall Street nears record high on trade, earnings optimism. So two things going on today, helping to drive the markets up in terms of the indices, especially the U.S. indices. And we can take a look at some of the other indices around the world, but the U.S. indices seem to have the most momentum today. And so maybe give the best opportunity to go after some potential profits. But we're talking about trade optimism. We're talking U.S.-China. Trade optimism is what they're talking about. Really, it looks like U.S.-China is set to sign a trade deal this week. They're talking maybe Wednesday, it looks like, or sometime near that. And so a lot of optimism on the markets, and it's really helping to drive the stocks and the indices up. And then at the same time, it's earnings season. Fourth quarter earnings are going to start being reported. And so some major companies, there's a lot of momentum involved with Apple, Facebook, Netflix, Microsoft. So that is helping to create some positive momentum as well. And so, and you know, we have a schedule here for earnings numbers, by the way, on our website. If you go under trading info, earnings releases, you can see the general date, time frame in the coming months, whether it's January, February, March, when major companies that are on our platform will be reporting earnings. So maybe tomorrow or the next day when we do the fundamental analysis webinar, we'll go over some of these specific companies. I'll show you how to pull up the earnings reports from the past reports, and also you know, see the dates that are expected for the upcoming earnings numbers, where you'd look to see those numbers as they come in, that sort of thing. But in any event, there's a lot of optimism surrounding those numbers for a lot of these companies, even before the numbers come out. And so that's helping, according to this headline, to drive the markets up as well. So, and it could be a lot of these companies have positive momentum because of the U.S.-China situation as well. That whole situation affects some huge segments of the economy for the U.S. and obviously also for China. Now, as we look at the economic calendar, well, first we can see a quick overview here, right? Everything's green except what's red. The fear index or volatility index, this VIX index, is red, which means fear is dropping. Makes sense when the rest of the markets are turning green, the indices, the stocks are green. Makes sense that the volatility index or fear index would be turning red, meaning less fear on the markets. It makes sense. And so probably also if we look at gold, you can guess which way maybe it's been moving through the day today. So we'll take a look at this, and I think the fundamental news will make sense with the technicals, and then you can start to get an idea of a technical plan with entry points, exit points, what type of moves might make sense for you. And the dollar kind of flat. Not up much, not down much. I know it's red, but it's actually negative 0.01%. It can't be much more flat than that unless it was exactly zero. So strength of the USD kind of flat. Markets in the green, reaching for new highs so far today, and the fear index dropping. Okay, so positive momentum in general on the markets today. The sentiment seems to be positive as we look at the numbers, as we look at the headlines. Now, specifically, a lot of announcements on the pound today. Okay, and it's been mixed. Some green numbers coming in better than expected, some numbers worse than expected, followed by more announcements better than expected for the pound. So a lot of numbers came in on the pound, kind of mixed results, creating some nice trending, up and down, up and down. So if you were scalping, it could have been a really good day on the pound. And if we have time, we'll take a look at the pound as well, some currency pairings. And there are some announcements later today as well in the USD, the Canadian, New Zealand dollar, etc. The big one might be some of these numbers coming in late, middle of the night, really going into tomorrow out of China. Okay, that could cause some movements on the markets as people keep their eye on, obviously, U.S. and China, the two biggest economies in the world. Those announcements are looked at closer many times than others. We also see headlines here about gold prices sliding as risk outlook improves. Okay, that makes sense, right? We were just talking about the fear index, quote unquote fear index or volatility index was in the red, meaning it was dropping. Well, that makes sense. Gold then would be dropping too if fear is dropping. And so, because gold being a safe haven asset typically. So why would copper be hitting 8-month high? What's copper got to do anything? What's copper have to do with? Why would copper be going up as gold drops? This is a probing question. I'm going to give you some information that makes sense, but I'm wondering if anyone has an idea. Copper is used largely in industry, right? You can think of even something as simple as copper wiring in buildings, that sort of thing. As economies are doing well, the use of copper goes up as industry is doing well. And so as gold drops when the economy is doing well, copper tends to go up, okay? And obviously none of this is 100% relationship, but in general, when you see all of this green and gold is dropping, safe haven assets dropping, you tend to see copper climbing, going the opposite of gold, okay? And we see that today. I just want to do a quick systems check. Type okay if everybody's with me still, hearing me clearly. All right, good. I've got enough responses. Typically, I have a little more feedback when I ask questions, so I just want to make sure everybody is with me. It's okay. If you're in a mood of listening and not typing, perfectly okay. Okay, so all of this makes sense, and it's predictable. Earlier today, if hours ago you'd have seen everything in the green and you felt the positive momentum on the markets, you could have been trading down on copper. I'm sorry, trading up on copper, trading down on gold, trading up on the indices, just based on the way the market sentiment seems to be. Okay, and we see the sentiment right away when we see fear index dropping, indices rising, futures rising. We see headlines like this: record highs, earnings optimism, everything looks positive. Okay, we get the feel, right? We've got the idea fundamentally. Then we go to the charts and we'll check out my demo here and we can say, okay, you can do the kind of a look back to say, okay, had I paid attention to this information this morning or earlier this afternoon, how well would I have done had I traded technical entry points now with my technical analysis in the direction that I felt the momentum might have been going, okay? And then we can take a step forward and say, okay, great. If I didn't trade on that, that's fine. What do I do now moving forward as well? So we'll use what already happened today as a learning experience of what you could have done or hopefully already did. If you've been with the webinars, you would have already known to do this. And then also we'll take a look at what you still could do with some of these major assets that have had great movement. And by the way, guys, indices, huge potential for making profits. They really do respond to the larger overall sentiment on the economy. Indices have multiple assets built into each indice, so it diversifies across the economy quite a bit for each major indice, and you tend to get large movements, lots of points, lots of movements in short periods of time where you can really maximize potential on profits. And then the same holds true for assets like gold and oil, lots of movement. Okay, not that currency pairings don't have good movement, they do, certainly they do. But some of these indices really have been paying well along with gold and oil, especially these past 6 months, 12 months with the way things have been going in the markets. Okay, so let's take a look. I've got S&P 500 on the screen. Let's say I've got 30-minute candles. So what happened at market open coming out of the weekend? Does anyone see on the chart? Starts with a G, okay? 3-letter word. What did we see happen? What did we see happen? Yeah, gap. And did it gap up or down? I'll draw a line on it. And if you were at the webinars last week, you already know what I'm about to say. Okay? The direction of the gap many times shows you the direction of the sentiment coming into the trading week, coming out of the weekend. Okay? And last week we looked at it, we said, look, when it gapped up, there are two things you can do, right? Many traders will test and see if it's going to fill the gap at all. Sometimes trading for the gap to fill, maybe 50%, whatever, to try and make a little money on the gap filling back. Also, once it starts to break the new highs, you can trade with the momentum, okay? Doesn't always fill the gap. If it breaks below where it gapped up to, okay, you could be trading down to with a sell stop maybe to start trading with the gap as it fills. Some traders are very good at timing that out. Or you can just wait for it to break to a new high and go with the momentum, right? And obviously you could do both. I've seen many traders do both. So once it gapped up, we do see that it broke below that opening price. And so had you gotten in, it reversed back up, you'd have taken a small loss on a fill the gap type strategy, unless you got out really early after a small drop. Okay, it really didn't fill the whole gap. Okay, no problem. Many times it does. This time it did not fill the entire gap. It filled maybe half of it. If you weren't being, well, I don't want to say you weren't being greedy, but if your strategy was to take profit after 50% of the gap is filled, okay, you profited. If you're holding out for it to fill the entire gap or 75%, it didn't make it today. It didn't come all the way back down to Friday's close. Okay, it got halfway back down. Now, the real larger movement was with the momentum of the day, which is even easier to do, right? Here's where it gapped up to. It tried to come back down into the gap. What kind of pending order could you have had above this initial climb that if it breaks above where it gapped to before it pulled back down into the gap, if it broke back above that high, you say, okay, it's going with the momentum. What kind of pending order would have gotten you in from this point up here once it confirmed that it was continuing with an uptrend? Yeah, buy stop. Very simple pending order. If you've never done pending orders, I'll show you real quick. Change from market execution to pending order. There are 4 types of pending orders. If anyone has questions as we go along, I'm happy to define what each one is. Or you can talk with your account managers, or obviously a quick Google search explains each one. Buy stop means buy from a higher point. Okay, and some might say, why would I wait for it to go up and then buy? Isn't it better to buy from a lower point? Well, technically speaking, yes, it's better to buy from lower points if it's going to go up after that. But many times the buy stop is confirmatory in nature, meaning you're programming to buy from a higher point because you want confirmation that the uptrend is continuing. Then you say, okay, now I'll get in. Okay, so that's the idea of the buy stop. It's confirmatory. Yeah, you're waiting for it to go up before you buy, which means you're buying from a higher price than you could have, but it's a trade-off because at least you're more certain of the uptrend because it broke through this first resistance level. And it confirms what you already saw in the stories, like we just looked at with the fundamental news real quick. You do a quick, could have been this morning, early afternoon, whatever it might be. You could have taken a quick look at the headlines and said, ooh, positive sentiment. You look at the chart, it gapped up. You say, okay, if it confirms an uptrend, I'm in. Okay, and so had you gotten in as it broke this first high after the pullback into the gap, once it broke to a new high point, if you got in here, okay, being fair, you didn't get in at the lowest point, you got in after the first breakthrough on this resistance level, you'd have gotten in around on the S&P 500, what, 3250 or so. Okay, where's it at now? Even if you waited till now, it's pulled back some, 3282. It's up over 30 points. Okay, so a one lot position is 100 indices. Okay, that's a nice payout even if you got out now, right? Without being in a hurry. Got in on the buy stop, getting in even after all this climbing. It goes up 30 points. If you have a one lot position, 30 times 100, that's a nice payout. Okay, 30 times 10 is 300, 30 times 100, 3,000. Right? So a $3,000 payout in such a short period of time with a simple breakthrough move, just going with the momentum of the day, going with the direction of the gap, backed up by the fundamental news that we looked at, and using a technical analysis strategy of if it breaks the resistance, I get in with my buy stop. You've got multiple reasons there maybe on your checklist why that would have been an easy decision to make that move. Okay. Now, I'm not saying a one lot position as if that's the right trade size for everybody, right? You decide what trade size is right for you. Could be a tenth of a lot, a quarter of a lot, a micro lot, depending on your balance, right? Got to trade within your means and the flexibility of your account. But obviously, the more you have in your account, the more flexibility you have to go after even larger profits if you see fit to do so. All right. So the idea of trading as it breaks through the resistance, if you were using a stop loss, okay, if you're programming a stop loss as you entered, as this buy stop opened, if you had a stop loss programmed, where might you have your stop loss? If you're entering as it broke this resistance here, if you entered here, where would it have made sense to have a stop loss in case it went the wrong way? Technically speaking, if it broke the resistance, that resistance line then now should be support. So yeah, just below the old resistance. Good. Makes sense, technically speaking, right? That if it broke the resistance, maybe it won't break back below. And many times I like to go 2 levels down. And I'm going to show you on this chart why that would have paid out well here and why having your strike zone too narrow would have caused you to get out of the trade too early. Okay, let's take a look at what I'm talking about with widening the strike zone with your stop loss, or you could use a hedge position instead of a stop loss so you can stay in it until it goes the right way if you're confident in it. Okay, so if you put your stop loss just below the support, let's say right here, okay, you only have one line of resistance before you hit your stop loss, or in this case, one line of support, right? And you see here, had you not taken your profit up here, maybe you would have taken the profit already here. Had you been waiting for something higher, like where it is now, this wick would have hit your stop loss if you had it just below the support. Okay, many times, like in past webinars, last week, prior week, I say I like to have 2 levels. Okay, Soma, exactly. This is what I'm thinking. Okay, and everyone can have their own opinion. But Soma, you're saying just below the previous day close. Very good. Wouldn't it take a lot of momentum to break back below where it gapped up from? It gapped up. It makes sense. It might return to the gap, but it shouldn't. If it's truly positive momentum, it shouldn't break below Friday's close, right? So if I'm putting my stop loss not just below this broken resistance, which should be support, and it tried to act as support, but it tested it and went back up. If you put it below where it gapped up from, here's Friday's close, odds are it shouldn't break below that close, but it shouldn't break below the gap, right? Now you might say, okay, but now I'm risking more. So take a smaller trade, right? If you were willing to, let's say, take a 1 lot position to put it down, to put your stop loss down here, well, if you're putting your stop loss 4 times further down to be more certain you don't get caught with this little spike down, then just take, if you were going to take a 1 lot position with your stop loss here, take a quarter of a lot position with your stop loss down here. Now I've widened the strike zone. I don't have to risk more. Took a smaller trade, right? I'm willing to go after a smaller profit, but it allows me to be more patient with the trade. And many times you'll see this can improve your win percentage. Okay, if truly the momentum of the day was positive and you believe that because of this gap upward and because of the headlines you saw, why be so impatient that you're going to get out just because it dips below this little support that it broke temporarily, right? Have potentially a wider strike zone where you're below the gap, and then it would have to take some really reversal of the day's momentum to break below Friday's close, to break below where it gapped up from. And you see it never did. It tested the gap, never even broke below down to Friday's close, didn't close even the entire gap any lower than it did here, okay? And it went right up to almost a new high, okay? So you can see the power of just being a little less greedy, and I say less greedy, could use a different word, less aggressive maybe, if you have to just take a smaller trade, widen your strike zone, many times this is the effect. You can be more patient, have a logical reason for where you're widening the strike zone to, right? We had a gap. We put it just below that closing price from Friday, just below the gap that came up. It made logical sense to do that. And look, it would have worked out great. Nice potential profit on a one lot position, 3,000 profit. And had you been trying to cut it too thin here, well, then you lost, right? Or you re-entered, which would have been okay, I guess, if you have time to keep an eye on it like that. Type okay if you're with me on that idea. Being patient with your stop loss if you're using one. What I call widening the strike zone a bit so you don't have to be so perfect. Having two levels that have to get broken through instead of one before you give up. Okay, and you'll notice that by being a little less aggressive, maybe smaller trade size, more patient with how long you're willing to stay with something, you may very well notice you improve your win percentage that way. Okay, I have someone complaining their sound is gone. Type okay if you're with me still, audio-wise. All right, thank you. I've got enough responses. It's just you. Audio is good. Okay, just typing a message. All right, so, all right, good. If there aren't any questions, we can take a look at what about moving forward right now. Great that we could have had a breakthrough, easy buy stop strategy, and you know, on a half a lot position, 1,500 or whatever size trade was right for you, could have been a nice payout and gotten out of it already. Now, why might now have been a good time to get out? And that's important. Just as important to know why you'd get out of something if you're scalping, in this case, short-term trading through the day, what we call intraday trading. Why would I have gotten out maybe near this peak? What do we see off to the left? Yeah, it's close to the resistance. It's expected that as this was running up with so much momentum, look, here's the resistance. I just drew the line. Resistance, resistance. It makes sense. As it got close, it started to drop. So if you're scalping, that might have been a logical spot as it got close to this resistance to take the profit. Even if you took it now, that's pretty close to that resistance. That's a nice rise. It's, you know, I tend, in my mind, if I can get 75% of the movement, I'm happy. Okay. I don't try and be perfect and go all the way to that next resistance level if I'm doing a scalping strategy. So many times it'll reverse just before it. Okay. And then now you give back some of your profit. All right. So it is a personal thing, how patient you are with how far you want to let it go. If you're doing scalping type trading like this, with little breakthrough moves that run during the day, I tend to try and get out with, before I get in, I already know I want X amount of this movement, and then I'm happy to get out. There are some, you know, if you feel like the momentum could continue, you could do a partial close. Okay. If you've never done a partial close, I'll run through it real quick. I'll open, I don't know, a one lot position and buy. Let's pretend this is in profits now, and it rose up, and I say, wow, okay, I'm going to take profit, but I think it might keep rising. If that's how I felt, then I can easily, there's a couple things I could do. I could put a trailing stop. Okay. You right click, go to trailing stop, and you can add a trailing stop distance so that if it keeps rising, the trade stays open. If it goes back that trailing stop distance at any point from the high water mark, it closes it for you. That's one way to preserve profit once you've reached an amount of profit you're happy with. But if you want to still give it a chance to keep running, trailing stop, be careful with that. It's only client side, not server side. So if you log out, trailing stop's gone. If you lose internet connection, trailing stop's gone. So you might still keep a backup standard stop loss too, or some other way to protect your trade in addition to the trailing stop. That's one option for preserving profit. The other option, as I was about to show, let's say it's in profits and you say, okay, I want to preserve some of my profit but leave some of it open. We can go to market execution. I can change the trade size to the amount I want to close. Let's say 0.75. Let's say it's 75% of the movement to the resistance is done, let's say. So I say, okay, I want to take 75% of my profit. And so I say, okay, I want to close 0.75, not sell or buy, but close. and it has the order number, matches this trade. So I click close on that amount, and you'll see the open position will change from 1 lot to 0.5. Okay, so now I've pocketed into my balance that portion of whatever profit was showing, 75% in this case of that 1 lot, and 25% I'm leaving open. I'm willing to risk that it might drop back down, or I'm hoping it goes running the right way. Even if it dropped all the way to my stop loss, depending on where I put it, I'm still an overall profit maybe, even if I give back 25% of that client. Okay, so these are different ideas for managing where to take profit and different ways of preserving profit once you think maybe the main movement's done, but maybe you want to stay with it partially as well. Okay, any questions on that? AUDJPY, you're asking, don't you need to put a stop loss before you trail your profits? Everyone does things different, right? But in some way, you should manage your risk, right? So whether that's with when you first open the position, you could have put a stop loss mark somewhere below your entry point, and as it progressed up, you could manually change that stop loss and drag it higher, or you could leave it where it's at and add a trailing stop. Okay, you can have both going at the same time, and obviously you can also do the partial close idea as well. Good question. Okay, so what about some of these other indices? S&P 500, strong run up today with all the positive news. Oh, and we were going to look at what can you do now. Okay, if you didn't already, and you see it's still climbing. I'm almost eliminated the spread already with that position. Okay, so we see it's starting to try and turn green again. Now, if we go to, let's say, 5-minute candles, I don't see a strong downtrend starting yet, but it looks like it's trying to pull back a bit, right? Now, I tend not to like to trade against the sentiment. And we just looked at all the sentiment, and the sentiment was positive, seemed to be positive sentiment. So ideally speaking, if you prefer to buy on today's market and not sell in terms of the indices, then maybe you're being patient to see if you get an opportunistic pullback to maybe an old resistance level. Let's say it pulls back to here. If this pulls back down and hits this old resistance level, which now might be support, maybe you have what kind of pending order would buy if it dropped, let's say, to this support level? If you have it programmed to buy in case it drops down near this old resistance level, if it gets near what should be a support level down here, if you program it to buy from here, what kind of pending order buys from a lower point? Yep, Ebert, you're on it, buy limit. Okay, so maybe you prefer to be patient, not do a market move right now. Maybe you say, okay, I missed the climb. Doesn't mean I have to get in on a climb, even though the sentiment seems to be positive. Maybe you don't like the entry point to buy right now. Okay, so that's what some of these pending order types are for. You can say, okay, I do want to buy. The sentiment seems positive, but I don't like the entry point. So in that case, you could program somewhere lower strategically in terms of technical analysis, maybe on top of the next support level. And you might say, if it drops to that support with the positive sentiment today, I think it should bounce back up. And so maybe you program a buy limit to buy from somewhere down here. Okay, that makes sense in terms of technical analysis paired with the fundamental sentiment. Okay, it doesn't mean it has to win, right? But this is how you trade, right? You take as much information as you can to hopefully be right more often than you're wrong, right? And now obviously you're going to protect yourself on the downside with a stop loss or a hedge trade at a place that makes sense to you, right? Or in some other way, limit the potential for loss that makes sense to you. So and so we can see this is trying to drop. Now some might sell and say, I think it'll drop to the support. If that's how you feel, sell. By all means, you can sell and go against the general sentiment of the day if you feel it's due for a pullback. I personally tend not to like to go against the sentiment of the day. I'd rather be patient and wait for an optimal entry point to go with the sentiment in terms of my technical analysis. We're all a little different with that. Okay, so that's what I see here technical analysis wise in terms of a potential opportunity. If you like the sentiment of the day, to it being positive, you could wait. Buy limit might make sense to you then to buy up off the next support level that it might reach. If you feel strongly that it's due for a pullback, you could do a market sell right now until it reaches the next support level maybe. Okay, that's a nice distance of drop from here to here. If you're right on that, great. Okay, it did just break to a new low. Okay, it's showing a downtrend right now, which is another reason maybe to be patient on a buy, right? It looks like it's in a little bit of a pullback right now. Okay, someone's asking where to put a hedge. Typically, you set the hedge up to be activated only after you've already entered on the primary move that you believe in more. So let's use the S&P 500 right now as an example. Let's say you believe more in a buy than a sell, okay? And let's say it already came down here and you bought, your buy limit kicked in and it's off and running. And you've got now you're on the market on a buy. Down here, you could have already prepared because it would activate second. You know this one will activate first. You prepare at the same spot you would have put a stop loss. Instead of putting a stop loss on the buy position, if you believe in the bigger picture, even if it breaks the support, that it'll go back up because of, let's say, US-China signing a deal later this week, and you say, even if it breaks that support in the near term, I believe that the markets will go to a new high, so I don't want to give up on my buy. I don't want to close and reopen and repay the spread. So you say, okay, what I'll do, instead of putting a stop loss here and risking that I get stopped out and then it goes up while I'm sleeping or something, I don't put a stop loss on my buy. And if it drops to a certain point, I have a sell stop prepared for the same size as my buy. Now I'm fully hedged. If it breaks the support and plunges, I'm fully hedged. I'm breaking even now as it's dropping because I have the same size sell as a buy. And if it reverses and goes back up, as in this example, I'm saying is your stronger belief, then you have the stop loss on the sell stop. You have a stop loss on that sell position after it activated, not on the buy position. So now if it goes back up, it closes the sell stop and the buy is still open. Why did you choose to leave the buy open and have a stop loss on the hedge? Because the whole point here is you believe in the bigger picture more in the buy than the sell. Otherwise, you wouldn't set it up that way. Does that make sense, Ebert? And everybody else? Now, I always say, and you can do it how you wish, I always leave a second level, a backup level hedge that doesn't have a stop loss. Meaning my first hedge might kick in below this first support. If it dropped all the way to the next support, I might take profit on the hedge and have another hedge in case it breaks the next support to cover myself. Okay? And that last hedge position, I don't put a stop loss on so that I know in the end I'll stay protected in the bigger picture in case it continues to plunge. In case it goes down, pops up, goes down, no matter what, it stays hedged. This first hedge that has a stop loss, if it goes back up, it is possible. It goes down, activates the hedge, goes back up, closes your hedge. The buy is still open without a stop loss, and then plunges again. You got yourself covered with a second hedge position a little further down without having a stop loss on that last hedge trade. Okay? So you leave yourself protected just in case. If you closed the first hedge trade with a take profit, banking that it'll go back up, or it went up, closed your hedge, and then dropped, you're protected with a backup hedge a little further down. Okay? Just in case. But you're only setting it up this way if you believe in the buy more than the sell. If you believe in the sell, you think something crazy is going to happen, and you believe the market's going to plunge, then if you're on a market move on a sell, then your hedge position's up here as a buy stop. It's the opposite. It's flipped. Okay? So in this strategy, you're only hedging if you believe in one direction in the bigger picture more than the other, and you're covering yourself in the short term with the hedge until it goes the right way, and affording yourself to be as patient as you need to be, because you're covering the risk if it goes the wrong way with only overnight interest, which isn't much if you're holding the position for days or weeks. But it gives you that opportunity to not worry about blowing the account, but being able to hold on to it as long as you want without risking much more at all. Okay, so this sort of setup, by the way, where you have multiple levels of hedge positions, where the first hedge kicks in. If it keeps going the wrong way, you take profit at the next support on the hedge. The buy is still open. It breaks the next support. You get in on the next hedge. I've seen people take profit on 2 or 3 hedges. The initial trade never went the right way, but you end up profiting overall because you're taking 80% of the profit on the way down. All you need is the initial position to pop back up halfway even if you close it in an overall loss on that initial trade, you've covered most of that loss, plus on the way down with the hedge trades that you're profiting on at different levels, that you're taking profit and re-entering on the hedges, that you don't even need the initial trade to profit, and you win on the trade set. Okay, you have to think of it more like chess, right? Step 1, step 2, if this happens, I do that. You're thinking 2, 3, 4 steps ahead. You can win on the trade set and be dead wrong on that initial move and still pull out a profit with just even a 50% pullback on that initial trade, closing it in the negative, but you made up 80% of that negative on the drop with the hedge trades. So it's okay if you end up losing some on that first trade. Okay, so just some ideas. Okay, so we can look at the NASDAQ. It also climbed nicely today. Even if we weren't even watching, right, the fundamentals. We've been looking at this for weeks and months, literally, with all of these indices. Simple breakthrough strategy. Here's the high point, resistance, resistance. You say, okay, if it breaks the resistance, there must have been positive news, right? Some people are purely technical traders. They say, I don't need to look at the fundamental news, because if it breaks the resistance, it must have been good fundamental news, right, for the market. So I put my buy stop above the resistance. It breaks the resistance level, and there it goes. Easy profit. Pure technical trading. Simple breakthrough strategy. Same strategy we just looked at on the S&P 500 when we were talking about going with the sentiment, or some that are pure technical traders are just going with the breakthrough. You see how nicely it would have worked. Okay, here's the resistance. You catch an eye on that resistance. You set your pending order. There's the breakthrough, and there it goes. As soon as it consolidates and moves sideways, that's your sign maybe to take your profit if you're scalping. Okay, very simple strategies where if you don't have time to follow all the fundamental news, pending orders, or what I call trip lines in the market, can get you in with when there's confirmatory breakthroughs. There you go, and off it went. With this type of rise, you could be wrong 2 or 3 times and be right once, and boy, you still can profit. Okay, so very nice movements on these. All of these movements right now seem to have slowed. I don't see any resistance point. We're at a new all-time high today on the NASDAQ. Okay, it's broken all resistance on the chart. I'm on 1-week candles. There's no resistance. Okay, so if we go back to 30-minute candles, 15-minute, 5-minute, there's nothing wrong with saying I can place a buy stop. If it breaks this high point, the momentum must be back. You could get in on a buy stop up here if you think the momentum's not done, and you could hedge it below with a hedge trade, as we talked about, if you wanted, with the idea that maybe you hang on to it through the US-China trade deal signing later this week. If you feel that's enough to break to new highs, you get confirmation on a breakthrough, you enter on a buy stop, you back it up with a hedge trade, and you wait a few days for the signing, and maybe it turns out very well. Okay, if you're expecting a pullback, then maybe waiting for it to pull back some here or here, if you want a more perfect entry point for a buy, maybe you program some buy limits, and you know you can do both. You could program a buy stop in case it just runs up now, and you can program a buy limit somewhere down where you think it's more ideal in case it drops down first. Okay? And don't let me talk you out of selling. If you think, if you're trading purely technical, right? I just pointed out some people trade purely technical. If it breaks the support level here, it's got room to correct. You could have a sell stop waiting if it breaks this support. You could have a scalp move ready for a sell stop to pull back towards the next support. Okay? That's for your purely technical trader, which we just looked would have paid well earlier today, right? So you don't have to guess the market. You could prepare for a sell and a buy at the same time, waiting for a breakthrough in either direction. There's nothing wrong with that for you purely technical traders. How about gold? Let's look at something different before we end things. What happened with gold today? Well, we're looking at 5-minute candles and we see downtrend, right? The market opened up here after the weekend and it dropped immediately. So it's predictable, isn't it? And isn't this confirmatory? If you saw the market open and you were thinking about buying on the indices that gapped up, going with the momentum, putting your stop loss below the closing price from Friday to be patient. And obviously in hindsight, that would have paid very well. If you, before you did that, you looked and said, wow, gold plunged. This was right when the markets opened. When the indices gapped up, gold took a plunge down, dropped $10, $12 an ounce. Isn't that confirmatory that, hey, indeed something positive is going on in the market? If you see gold go down so rapidly at the market open, in your mind, you might be thinking, there is positive sentiment. The safe haven gold plunged at market open. Okay, does that make sense? And I'm looking at 5-minute candles. I probably need to look back a bit further, going back over here. Okay, plunged from up here. Okay, but the same idea. Okay, so gold is moving down 1 hour, 2 hours, 3 hours, 4 hours, 5 hours, 6 hours, 7 hours. And if we go back further over here to when the market opened, it dropped also, okay, from up here. So we're talking from 1560 when the market opened here after the weekend, dropped down. You'd have saw this initial drop, same idea, but now we're looking at the correct location. Here was actually the drop at market open. And it plunged, gold plunged, and it continued to drop, and it has continued to drop after trying to recover. It's come back down again. Okay, so looking for confirmatory assets that tend to be indications that maybe you're thinking the right way about another asset. Okay, and I can give you examples of that. If you're thinking about buying on the Canadian dollar against the yen, maybe. What asset, if it's going up, might be an indication that the Canadian dollar could strengthen? What relationship does the Canadian dollar have with which commodity? Oil, exactly. That's an example. If oil price is shooting up and you have a 50-50 guess on Canadian JPY and you're saying, boy, I don't know. If oil is going up because of good economic news, Canadian dollar likely could climb because it's the #1 export out of Canada. Paired against the yen should weaken with good economic news like today. Now, if oil's going up because of fear of war in the Middle East, then the yen would strengthen because the yen's a safe haven. So you have to look at what's the reason for oil going up. And if it's good economic news and the Canadian yen dropped to a support level, that gives you maybe an indication, I can trust the support level. Because when oil's going up in relationship to positive sentiment on the market like today, then the Canadian dollar tends to strengthen. Now today oil was dropping. Why was oil dropping today with positive sentiment on the market? Usually good economic news drives oil up. Why was oil dropping today? It's an easy answer. The Middle East, US, Iran, less tensions, less fear of a war breaking out near the Strait of Hormuz, where oil shipments go through all day, every day. So today, oil was moving the opposite of what the markets were doing, but oil was moving in response to fear. or lack thereof in this case. So markets were up, but oil was not. So maybe I didn't decide to trade on Canadian JPY because oil was dropping. And if my indicator to buy on Canadian dollar is to also want oil climbing and oil was dropping today, hey, okay, fine. It was dropping. We saw articles. Oil was dropping because of fear dying down about the Middle East situation. And that's really helped the markets go up as well, okay, as oil dropped. So you have to look at the why also. What do you think happens to the Australian dollar with good news out of China? Australian dollar. Good news with US-China negotiations. What technical entry points might you be looking for the Australian dollar? As the US-China trade deal's getting closer this week, up on the AUD, Ebert says, and others, okay? Makes sense. Why? Because the number one buyer of exports out of Australia is China. If there's good news for the Chinese economy, then that tends to be good news for the Australian dollar. So you start to say, okay, I know what direction I prefer to trade. So now you know when you start to do your technical analysis on whatever asset you're trading on, and we could pull up the Australian dollar. Let's look at maybe Australian JPY. Look, up, 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 up. Isn't that predictable? Isn't that predictable? A simple breakthrough strategy here at the resistance, breakthrough, support. It's very predictable since last week and into this week that the Australian dollar would climb against the yen. Why would I pair the Australian against the yen to apply my technical entry points? If the Australian's expected to be strong because of good news about US-China, what do you expect a safe haven currency like the yen to do with good economic news? Yeah, safe haven should weaken with good economic news. So as you see, hey, there's less fear on the markets about war. There's reason for gold and the safe havens to drop, and there's reason for the Australian to strengthen. Then it makes sense to pair the strong horse, the Australian, against a weak horse, the safe haven yen. Okay? So you start to think about your pairings and you say, okay, I'd rather not pair the Australian against something that's expected to be strong. Let me pair it against something that's expected to be weak right now. And it can make a huge difference in the payout. Huge, just by simply pairing the Australian against the yen rather than against the Canadian or rather than against something else that might be expected to be stronger. Okay? So start thinking about that as well. As you're looking for your technical entry points with your technical analysis, think about the logic of what you're pairing against what as you do it. Okay? All right, I think this is a good place to stop. If there are any questions, now's a good time to ask or comments that you want to share. You're asking about resistance on the Australian. Let's look at the 4-hour. I see a resistance point here. You see here resistance, and it slowed right at that spot right now. It's trying to break it. Let me get rid of some of these lines. They're obscuring the view a bit. Let me get rid of all of the lines for that matter. It's my vertical lines really that were in the way. You see it's right at this resistance right now. Here's an old resistance point, and it slowed right at that resistance. If it breaks through, which it easily could this week, okay, it easily could break through. At some point, you might decide, I'm getting in because I think it'll rise to the next resistance level, which isn't up until this area around 76.43. That's like 50 pips up. Okay, it's still a 50 pip potential climb before the next resistance level. If you feel the fundamentals pair up with the technicals that you think the Australian should keep rising because as US-China sign their trade deal and talk about starting on phase 2 of a trade deal, if you think that's enough to create momentum up, then all you need to do is, if you've picked your direction, right, all you need to do then is zoom in on the smaller candles and find your entry point. And you could have two ideas with entry point. You might say, I'll trade up if it reaches the next support level down here. Old resistance. Maybe you say, I want to find a lower entry point to buy from because right now it's downtrending a bit. Or maybe you say, I don't care about this distance. I'll buy now. I'll hedge if it drops below the next support level, I'll hedge it. Maybe you believe in the bigger picture it's going to climb 50 pips and you're okay to get in now. That's up to each individual trader. How perfect do you want to be? Do you want to wait for a lower entry point, or you're just going to go with it now? I tend to want to at least see an uptrend if I'm buying. Even if the sentiment or the fundamentals say I should buy, I tend to zoom in on the smaller candles, and right now the smaller candles are downtrending. I tend to wait for an uptrend, in my mind, to be confirmed in the candles technical analysis wise before I like to make that entry point on a buy. Or vice versa, if you think it's going to drop, you wait to see the downtrend before you sell. Confirmation. I like confirmation before getting in. Not everybody's like that. If you think the bigger picture it should climb with US China, which it very well could, maybe you don't care about the specifics of the exact entry point. That's more of a fundamental trader then. Okay. But certainly there's opportunity for a rise. Whether you want to do a buy stop if it breaks this high point up here, you get in on a confirmatory breakthrough. Whether you're more of a opportunistic entry point person and you want to buy from a support level, it's okay too. It's up to each individual trader. Okay, good questions. I think we'll stop things here. We've been going for near an hour. Thank you all for joining. It's been some nice questions. And I think there's huge opportunity this week going into the US-China signing. There's huge opportunity on gold, oil, and the indices. And really some specific currencies related to China as well. Australian being one of them. Could see some really big movements. All right, thanks everybody for the good input, the good questions. Hopefully I'll see you tomorrow and Wednesday at the webinars if you can make it. Otherwise, they're recorded. You can check out the YouTube channel to view them same day, next day. Okay. All right, bye for now.